my pleasure to welcome you here to the Clark Howard Show, where our mission is to serve you with advice and information that empowers you so you make better financial decisions in your life. And today I want to give an update on FDIC insurance in the aftermath of a recent Fintech Meltdown that's left a lot of people just hungering for their money, and nobody's been able to give them good answers. Also, if you're in the market for a house, there was just a big fine paid by one of the lenders out there that was doing self-financing, lender financing for homes or seller financing, and a lot of people got burned. I wanted to talk about what you need to know when you're made an offer for a home that you have an option to purchase later, supposedly with that seller financing. We're going to talk that through. Okay, so we had an ugly situation happen earlier this year when a bunch of people who'd put money in fintechs, where you have an app on your phone and they say you can put money here and it'll go in FDIC insured account and your money will be safe while it's there. And when you want it, you pull it back out with the app and blah, blah, blah. Well, a lot of these fintechs themselves, none of them were FDIC insured, but they were working with FDIC insured banks. Well, many of them were working through a third-party tech firm called Synapse that then itself failed. And what's happened since is people have still not been able to get their money because nobody knows whose money is whose that's in various banks. So it's not like if anybody's been able to find that there was theft of the funds or anything like that, that could come out later. But all we know is people had these apps. They were putting money through the apps into FDIC insured bank accounts. The intermediary goes bust, and there's no records of whose money's whose. And it's going to take a long time to figure that out. In the meantime, people don't have their money. And people can't make a claim with the FDIC because no bank seems to know whose money they actually had. And this is a crazy kind of thing that happens in what I call blended banking. The way we do business with so many different organizations now, and everybody's touting FDIC insurance, but then what if that's a bridge too far like it was in the case of these fintechs? Again, the fintechs, as best anybody can tell, none of them did anything wrong. They, in good faith, were going through this third-party processor. The money was, in fact, going to FDIC-insured banks, as far as everybody knows. But now the customer of the fintech can't connect to the money. So the FDIC is like, okay, this is a problem. So they've issued a new regulation that the banks will fight over the next 45 days till the comment period's over. But under the new rules, when a bank receives money from a fintech, from an app, with that transmittal will come whose money that is. Just a ledger kind of thing where if I, as Clark, put money in through a fintech, and that fintech uses Christa's bank, and the money goes to Christa's bank, that Christa's bank will know it was Clark's money that they have on deposit. I mean, it's such a simple bookkeeping kind of thing. It's crazy. It was never required before. And I don't know why the banks will fight it, but they fight anything. But it will eliminate that concern that you might have. But that's only part of the equation. Because the other thing that comes up again and again, and there's been a continuing series of investigative reports by finance writer Jason Zweig, a lot of his work published in the Wall Street Journal, where there have been these organizations pretending they're offering fully insured accounts that pay these really crazy high rates of interest and even claim in a lot of their mailers and a lot of the solicitations that they're FDIC insured. And they're all scamsters. So this is where it gets really hard because you're looking for a place to put your money. And if both legitimate and illegitimate organizations are saying that the money's FDIC insured, how would you know who's real and who's not? So I'll tell you, it's actually easier than you might imagine because the con artists tend to promise that you're going to earn a minimum 10% on your money at a time that the best accounts out there that are FDIC insured, whether directly with an online bank or through one of these fintechs, is at 5%. So somebody promising you 10, 15, 20% on your money and claiming it's FDIC insured and fully guaranteed, those are people you can automatically put in the category that they're just trying to cheat you. They're just con artists. On the other hand, somebody says through a fintech you're going to earn 5%. That's completely in the realm of common sense.
Okay, we'll go to questions. Steven in Texas says, I just saw Experian is offering a way to shop for car insurance. Their website says it will help you get quotes from 40 different insurance carriers. What are your thoughts on using this service?
Nothing wrong with using the Experian service. I saw this thing as well in a solicitation from Experian. And what I like about it is getting you to think about shopping. And the more you shop for auto insurance, and the same is true for homeowners insurance, the better the prices are going to be that you're going to find. You just got to make sure that they are identical coverages, what you're comparing one to another. With the Experian shopping service, you should have that. Up to 40 quotes. Let's see what you actually get. As far as harm from using a service that shops multiple insurance, I don't see any harm to it at all. I see great benefit because most people who shop tend to respond to TV ads, and whichever ad was the cutest, they call that company and get a quote, and they may call another one, and they feel like they've done their work. The reality is, as I shared earlier this year, a study found that none of the top-rated insurers in the country are household names. That the people who do the best job in terms of customer service often will also have really great rates, are people who don't spend billions of dollars each year soliciting your business. And you may end up finding some of those companies that you're like, huh? Who are they? Through a search like the Experian one.
Gary in Georgia says, I've been looking at buying an electric golf cart. I see new 4-seater electric golf carts advertised for $1,994 delivered on AliExpress. Are these real offers? I'm an engineer and putting something together does not bother me. The offer reads that they provide free service parts. I assume you have to fix any issues yourself with parts that they provide.
Okay, so I was talking to a couple. I was out walking. I walk for every day. It's just my thing. And they were in this weird street legal golf cart that they had bought, not on AliExpress, but another of the Chinese websites. And they're just loving the thing. And they had to build it, and there were parts missing and all that. Mm-hmm. And so you have to be someone with an engineer's kind of mind, that you're really good at tinkering, you're really good at building things. A lot of people complain about the quality. Years ago, I bought a Chinese scooter from one of the websites, and it was a disaster. It was terrible, and I'm not mechanically oriented. I have far from an engineering mind, and that thing just, it was not my cup of tea. So know when you order any of these things from the discount Chinese websites, you're getting a really great price. You may not be getting great quality goods, and I would not trust any warranty they offer or customer service after the sale. You know, a new golf cart prices have dropped of late, but you're gonna find golf carts somewhere around $8,000 for a new one or higher usually, and paying $2,000 for one is awfully appealing, but it could be awful as well.
Yeah, and I know that it said delivered. Gary said that it's delivered price, but a lot of people complain they end up having to pay extra for shipping all of a sudden and that parts are missing. So I would just definitely pay attention to that. And then maybe you can't get the parts or it takes months to get.
Yeah, I mean, this is not a free ride buying any of these cheap wheels from China, I can tell you.
Rob in New Hampshire says, what is stock lending? Is it safe and is it a good way to make some extra money?
All right, so this is funny. We've had this question a few times in 24 from people because a lot of the brokerages are pushing this to clients. The most aggressive about it is Fidelity Investments. And there is very low risk to doing stock lending. It's where you lend your holdings in your portfolio to the brokerage and through the brokerage to people that are doing various forms of speculation. Your holdings are safe when you do it. Biggest problem is if it is in a regular investment account, is that you will have discriminatory taxation on your dividends that you're paid on your holdings that you're lending to others because they're not paid to you in the conventional way. And so where you might have a preferential tax rate on certain dividends, you'll now be taxed ordinary income tax normally on the cash equivalent of dividends that you'll receive. As far as a safe activity, yeah, are you going to earn big money lending your shares? Not unless you got a very large portfolio. Will the money really move the needle a lot? But it is a recognized, legit activity. If you're with a smaller brokerage house, you don't come under SIPC insurance when you do share lending. If you're with one of the bigs, there's not really a risk involved from that perspective. Coming up ahead, I want to talk about something that does have risk to it. It's these folks out there marketing houses on a rent-to-own kind of basis, with them ultimately being the lender. There's a lot you got to know and be aware of. We have a really unusual situation in the U.S. now with, historically, there have been a lot of individuals, people like me, who have owned individual properties that I've owned as investments, and I rent them out. Right now I have 2 rental properties. And it's historically been a diversification strategy and long-term wealth opportunity to be a landlord, to own investment real estate. However, what changed starting in 2011 is we ended up with big publicly traded or privately held Wall Street kind of firms that have been buying properties around the country for cash and then in turn renting them out. It has had a not negligible effect, but not hugely meaningful effect on home prices around the country, as inventory, particularly at the lower end of the market, has been sucked out of the market of homes for sale and has instead ended up as rentals. And some of these big organizations, publicly traded or private equity, that have owned a lot of homes have engaged in a lot of abusive practices. And one of the big players recently got fined many millions of dollars, should have been more, for abuses of their renters. And we're in a cycle now where a lot of the Wall Street crowd that bought bulk purchases of houses more than a decade ago through about 2017, maybe bleeding into 2018, have now decided, okay, now's a better time for us to maybe transition a lot of these houses from rentals to homes that we sell. And that's where a lot of abuses are happening, because this same Wall Street crowd, wants to make money from every angle, even if it skirts the law, bends the law, or breaks the law. Not everybody, but it's been a problem. And so now a lot of these organizations are offering rent-to-own kind of programs where you are, with them being the equivalent of a landlord and lender, are in a contract where you ultimately think you're going to end up owning the property. And these things are referred to as contract to deed or land contracts. And the idea is that you're paying for what you think is a purchase of the property, but without even the rights of a tenant. When someone offers you, from one of these slick Wall Street organizations, when they offer you the opportunity to own a home you're renting, and they hand you something referred to as either a land contract or a contract to deed. And all you're thinking is, I'm sick and tired of being a tenant. I want to own my own place. And they dangle that in front of you, but the abuses that have come with this are so bad ugly, because you're paying more money than market equivalent rent for the idea you're going to own the place. But at the same time, the landlord slash quasi-seller has all the cards, and they can burn you big time. A lot of these contracts, you're responsible for all repairs, all maintenance on a property you don't actually own. The deferral of ownership is till you paid them all the money that is required to purchase the property. So know that if you are being offered any kind of rent-to-own kind of thing, whatever term they use, know that you need to do something that maybe your instincts normally would not be. And that is, you need to pay a few $100 to take that contract before you sign it to a real estate lawyer, and have the real estate lawyer review the contract and see if this is a one-sided, ugly deal. It could be okay. Odds are it's not going to be, and they'll warn you away from something really, really hideously awful and ugly. And I'm just incensed about this so much, because there's plenty of money these Wall Street organizations made buying homes when the market was really great to buy. And they're gonna exit with huge profits. To now try to cheat people on the way out is beyond abusive, and it is unacceptable. You know what will happen? There will be these settlements like the one I just alluded to, and for the Wall Street crowd, it'll be pennies on the dollar, but they'll make the dollars, and the restitution will be pennies. And that's why you have to protect yourself up front with any option to purchase contract or lease purchase contract.
All right. This question came in from Joseph in Texas. Hey, Clark, I love the show. Some of my earliest memories were road trips with my dad playing you in the car. I'm 22 now, and I have an investment property in another state, along with my primary residence I just purchased.
Congratulations. Wait, at 22? 22, you have an investment property and your own primary residence?
That's crazy.
That's pretty great.
Okay. My question comes with the details of the recent purchase. I bought new construction as the area I moved to is expanding quickly, and the company I bought from was just horrible. I wish they had a Clark Stinks. From day one of looking at the house to the actual purchase, they had their hand in every step of the way. They were the seller, title company, insurance company, and financier. Is this normal? Every part of the house buying experience through them was just so painstakingly awful. I almost walked away with or without my earnest money. I had to submit documents sometimes 5 times over, as the underwriters couldn't seem to keep track of anything. They waited until the day of signing to inform me that I did not get approved for their in-house financing and I would have to apply through their secondary or forfeit the earnest money. I had to sleep on a friend's couch and get a storage unit for the month following because of this. I tried to bring my own lender to avoid their in-house shenanigans, and they told me that was not an option, that I would forfeit the sale. I ended up losing the promo 5% interest rate because of this. How and should I report this? It all seems shady.
So, Joseph, first let me explain. It is normal in new residential construction that the builder, both to make the process extra smooth, which it was not for you, and to make extra money on you being involved in self-dealing with them either operating or receiving commissions from various elements that go into buying a home. So they make money not just building and selling the home, they make the money on the other things that you have to do. Their in-house financing, all those things. Now the in-house financing, you mentioned the 5%. That's actually something home sellers have been doing from these big production house builders, and the one you had is one of the large publicly traded ones. When they're doing that, they are subsidizing that mortgage. So you lost the subsidized mortgage rate. I don't know what all went on there, but having the builder involved with all the elements is absolutely common with the huge production builders. And it blew up on you. All I can tell you is who you would report to. You'd have to be very specific in a complaint to the Department of Banking and Finance or whatever the equivalent name is in Texas. And I don't know what their administrative procedure is. And I don't know exactly what happened with the underwriters that they didn't approve you for the subsidized financing. It all sounds like this was a just terrible experience for you, particularly having to sofa surf, couch surf for a while. That's a terrible thing to do when you thought you were going to be sleeping in your own home. You were going to have a refinance opportunity before not too long, and you'll be able to take out the higher rate loan that they did write you for a lower rate one. At the same time, I love your perseverance. 22, already owning 2 properties, and you didn't let them keep you from being able to get this home. That's really good stuff.
Witonia in Georgia says, I recently purchased a new construction home. The mortgage company suggested that I pay an extra $360 toward my escrow each month. The reasoning is that the tax was calculated based on the land rather than the house on the land. My house has been standing since March of 2024, and I purchased the home the end of July. My question is whether I should make this extra escrow payment each month for the next year or put this money into my savings and have it available if I need it after my first year.
Keep the money in your own savings account. Really put it aside each month. Their estimate may well be right because in a lot of states, when new construction homes are sold, the taxes were still figured on land only when you first occupy. They'll then hit you with a higher bill because when they figure out it's sold for this much and it's got a house and the land. But I don't want you to pay that larger estimated escrow when it's not required because they're not paying you any interest at all. And in the meantime, you can, in an online savings account, shop around. You can earn up to 5% on the money, earn it, and then pay the escrow shortage when that time comes.
Donna in Georgia says, recently my husband and I were opening a CD at a local credit union where we have a joint checking, savings, and other CD accounts. When talking with the bank representative, my husband asked for them to turn the computer screen around so that the rep was viewing to show me the balances. His reply was, I can't because it has personal information on it. My question to Clark is, what kind of personal information about us does the bank have that they don't want us to see? We did not think fast enough to ask him that. Thank you.
Donna, this isn't a bank. This is a credit union.
Yeah.
You're one of the owners. I would ask the question again. I don't know if they have Social Security numbers there, what kind of information they have that they may have notes about something about one or the other of you. You don't know what their internal system is. But I think it's perfectly reasonable to ask beyond that, because it's weird that they won't share the screen with you. I can't imagine. They may have a legitimate security concern that it was not turned around. I would love for you to find out what that is that would be something that they couldn't show you. I mean, your husband could have on the app signed into his account right there and shown you what was on the screen that the credit union representative was looking at. But I hate that kind of stuff, all that secrecy stuff in the banking business, and I hate to hear it infecting credit unions as well.
I mean, I could see it if maybe they're in an open cube kind of area, and the policy is you don't turn your screen around if there's a social on there because other people could walk by and see it. I mean, maybe there's a policy.
I would think there would be a social security number, and I don't know what else might be there.
Hopefully it doesn't say, like, these people are mean, you know what I mean? Like, I'm sure they're not, but, you know.
Oh, no,
do.
there are systems that various companies use where there will be notes about a customer being difficult in various ways.
Well, I cannot imagine that that's the case here, but.
So that's why I'd ask. Remember, it's a credit union. You own it. They work for you. So I would ask the question, why is it, what information is there that you weren't permitted to see the screen? And they may have an explanation that makes perfect sense. The likeliest, the lowest hanging fruit is that social security numbers are showing right there. But I don't know what else could be. And we might hear from someone else who works in a bank or credit union who could tell us what that might be. But
or maybe they stink. And tomorrow, you're going to hear about how you stink.
Yeah, I can't wait, because Clark Stinks is my favorite part of the podcast we do every week, because it's so important that I grow, that I learn, and that I think about things in ways that my little brain didn't absorb. And so I just love the opportunity tomorrow. And what we're all in this together for is to all learn ways to save more, spend less, and avoid getting ripped off. And we'll see you tomorrow.